My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save a little money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. If you didn't know any better, you might think the Federal Reserve should be cutting interest rates, not raising them, which we now somehow accept as an inevitability. The data for pretty much every industry I follow is coming up short. Yet at the same time, it's become a matter of when, not if, the rate hike will occur, which is precisely why the Dow tumbled 115 points today. S&P dropped 0.63%, NASDAQ declined 0.55%. Now, it's bad enough that our first quarter GDP came in an astonishing minus 0.7% this morning, with our country's exports being severely crimped by none other than, yes, the strong dollar. But our early read on everything May, from a tepid Chicago Purchasing Managers Report to declining consumer confidence to our own work here on the transports, suggests a startling decline in commerce in the last 5 weeks. You don't raise interest rates into a faltering economy. Heck, you don't even talk about raising rates. However, it almost feels like the Fed is courting what happened in Europe a few years ago when former central bank President Jean-Claude Trichet put an all-clear through and then added 2 rate hikes to boot, pushing the continent into a tailspin that it's still really trying to recover from. So why not take every stock and then sell it? First, it's possible the Federal Reserve comes to its senses and Fed execs stop yapping about how a rate hike is inevitable. Second, there are positives happening outside of our country that could reverse our export deficiency. Which brings me to the game plan for next week, because the endless Greek tragedy will be played out again on the European stage this weekend. And if they actually resolve things, which I think most people think will not happen, our stock market could rocket higher, because a Greek deal, it could lead to a much stronger euro, weaker dollar. That's incredibly bullish, because as I've been saying for ages now, we cannot have a sustained advance in our stock market unless the dollar has definitively peaked. But a rate hike without a Greek resolution would send the dollar soaring, and we get a raft of analyst number cuts for the big international companies. The impact? Let's see. Over the last decade, June's been negative for the Dow Jones average 80% of the time, with an average loss of 1.6%. The Dow's chock full with big international-oriented stocks. So I think if the dollar stays strong, then June's ugly history could repeat itself. Not what I want to say right now, but hey, the data tell you that way. What else is on tap next week? On Monday, we might learn of a deal in the healthcare space. Remember, I've repeatedly said and told you there could be imminent consolidation in the HMO space and suggested in last week's game plan that Humana could be the target. Today, Humana acknowledged the possibilities of a deal, and the Wall Street Journal said the company's working with Goldman Sachs on a potential sale. That's why Humana skyrocketed more than 20% in this one session. I think where there's Friday smoke, there could be Monday fire. What's next? PVH reports Monday, and we got a pretty positive read about this quarter's potential from CEO Manny Chirico when he came on the show to talk about the company's last quarter. I am worried about the stronger dollar impacts on PVH since it has such huge overseas exposure. But I also know the stock doesn't reflect a ton of positives right here. Might be decent risk reward. Market's okay. Retail's been so hit or miss. I mean, frankly, it's unnerving. The bargain store cohort has been among the strongest segments, though, and I think we'll get a positive read for the future when we hear it from Dollar General on Tuesday. Now, there's a problem when they report, though. This darn West Coast port slowdown, I think, hurt them. Dollar stores buy tons of cheap Asian imports, as we learned from Dollar Tree earlier this week. So I bet the headline number's bad, and then I think the outlook would be good. Maybe that's where the opportunity comes in. Here's one that might be an actual just buy ahead of the report. Tuesday, Medtronic, the medical device company, is going to tell you about how well its merger with Covidion's working. Remember, they merged with Covidion in January. This quarter could show how powerful that combination could be. Lots of synergies. I bet we get a nice upside surprise when Medtronic reports. Good one for a trade. We're big believers in profiting from all sorts of vices here on Mad Money. Brown-Forman, really the only American hard liquor play, reports Wednesday. And while the maker of Jack Daniels has its detractors on Wall Street, bourbon's red hot, and Brown-Forman's been able to capitalize it. I like Brown-Forman stock. Now, here's something you got to circle. FireEye holds an analyst meeting on Wednesday. And if it's anything like the preview we had when we spoke to CEO Dave DeWalt last week, then you might want to own some going into the meeting. We're in an uncertain, uncharted market now. I've been stressing that to you with my cautionary tone for weeks now. And now more than ever, you need powerful themes as tailwinds when you buy a stock. At the moment, no theme is more potent than cybersecurity, and FireEye is at the center of it all. With its forensic team being brought in to deal with many of the big intrusions that we hear about all the time, FireEye also has an excellent threat prevention platform that's gotten a federal government seal of approval for those companies that want legal immunity from cyber crime. You think the economy's slowing like I do? Then on Thursday, well, you might want to hear what J.M. Smucker has to say. That's the aggressive and acquisitive food company. Smucker and Hormel, which we spoke to earlier this week, have been among the best performers in the group, and Smucker can keep working even in a higher interest rate environment. Oh, you know what's something else? Oh, I just want you to keep your eye on Mondelez. It was kind of interesting trading today, so to speak. Stock's been levitating. I like it very much. Another company we've been championing, Verifone, also reports Thursday. Everything involving the cash register has been red hot lately, and that includes Verifone. I'm talking about Apple Pay. I'm talking about eBay's PayPal. Now, the last quarter for Verifone was terrific, but it was initially misunderstood, and it hurt the stock. So I'm betting that sequence could happen again. I like Verifone symbol pay long term. So if it gets hit, we'll take a closer look to see if a big opportunity is once again upon us, as it was last time. I also want to hear what Ciena has to say about networking equipment. Talk about an area that's really heated up lately. Have you seen this stock? Ciena, Juniper, and Cisco have all been delivering some pretty superior numbers. I like Cisco the best because it's the cheapest and the safest, but I understand that Ciena's been a big winner in 2015. In fact, I have to think it might be too hot. Maybe be careful going into the quarter. Finally, don't mean to bury the lead, but we get the Labor Department non-farm payroll report at 8:30 a.m. Friday, and I'm more fearful of this number than I have been in ages. Why? Because while almost every other piece of data about this economy is coming weaker of late, employment's been the lone bright spot. It's getting stronger. A big number with lots of jobs created gives the Fed the ammo it needs to put through an imminent rate increase. And like I said, when that initially happens, even though it may be okay in the future, instantly it will be bad for stocks. Yep, if we see lots of job creation, I think the market could go lower. That's because we'll be fighting the Fed, and that's always been a wrong bet. A weak number, on the other hand, could get the Fed, well, maybe they'll stop, they'll put a cork in it, so to speak, and that could spur a decline in the dollar to boot, and then we'll get a rally. That's an awful lot on the line for one stat, isn't it? But we know from history, as documented in Get Rich Carefully, that this employment number trumps virtually all other inputs. So be aware that this is a wild card for the entire market, and sometimes you need to see that wild card before you do any buy. Remember, this is the quintessential big bad event, and we could be down in the stock market ahead of the jobs report given the stakes. So if it's at all weak, you can expect a terrific rally to ensue. Here's the bottom line. We're not getting the kind of action I find encouraging right now with weaker data accompanied by a steady drumbeat of the need for a needless need for a rate hike from the Fed. In this environment, I'm advising some caution here, as the risk reward is diminishing for the bulls without a change in tone from the Fed. They have to change. And if we get a jobs bonanza on Friday, then expect the entire market to get mauled. Joe in Texas. Joe!
Booyah, Jim. Joe Weaver calling from Longview, Texas.
Oh, man, now there's a city of hope. What's going on?
Well, I've got some gold. And with Greece about to blow up, I'm thinking of doubling down. What do you think?
I like owning gold as an insurance policy. I'm not going to tell you to step up and buy more because gold has not been a good thing, but I like your idea of owning gold. And I share with you that that is a good place to be for a portion of your portfolio. But I've been saying that for 10 years now, of which 8 were terrific. And now it's just insurance. John in Illinois. John.
Hey, Jim, thanks for taking my call. I'm a long-time listener, second-time caller. Start out with the big Chicago Blackhawks. Booyah.
All right. A lot of Ranger enthusiasm in town here. What's happening?
Jim, I bought a speech recognition software for my home computer a couple of years ago by Nuance Technologies. Liked it so much I bought the stock in October of 12. It went down about 40%. I bought another chunk and I'm almost back to even. They've got some new technologies they've developed for the medical, of course, and they're looking at the auto market and next generation TV. And I thought I'd just get your sense on what's your thought on a go-forward basis? Is it cheaper?
It's not my favorite because there's so many other players. You know, I like this big. You know, I like the Skyworks. I like Avago. You know, I like the Corvo. NXP. I like them all more than Nuance, frankly. All right, things are gloomy right now, and I am advising caution. We'll get through it no matter what comes our way, though. On Mad Money tonight, the U.S. is spending less on our military, and our leaders are more reluctant to go it alone. But should you withdraw from the defense stocks? Oh, you don't want to miss my take, believe me. Then you may be tempted to buy the airlines as the group loses altitude. Is it the right time to book a ticket? I'm checking in on some of the best names in the group. Plus, from Shake Shack to Jack in the Box, there are a whole lot of cooks in the kitchen. But should you join the burger war? Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.